makers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London with the conversations that matter. Here's what's coming up on today's program. Treasuries dropping as the Fed's Christopher Waller says there's no rush to lower rates. We're going to look ahead to tomorrow's U.S. inflation data. Meanwhile, in the stock market, the S&P 500 futures pointing to a higher open on Wall Street after closing at a record high. Meanwhile, here in Europe, Stock 600 also hitting that all-time high on the last major trading day of the quarter. Plus, we are on intervention watch. The yen steadies, with many traders eyeing 152 per dollar as a possible trigger for officials to take action. In the meantime, a quick check on these European markets. When you're looking at potentially this last trading day on the screen, you are seeing broadly green on the screen across the continent. And that is interesting, given that you would think ahead of a very long weekend, especially on Monday when European traders are not going to be in. American traders will be digesting some of that PCE data, the inflationary comments from Powell as well. How do you position ahead of that? Well, it kind of feels like autopilot seems to be the name of the game this morning. The Stock 600 higher by 0.2%. Slight outperformance right here in the UK. In the meantime, I want to get a quick check on futures action across the pond as well, because U.S. futures virtually unchanged at the moment. S&P futures 53.0475 on those contracts. Slight underperformance in the NASDAQ, only down 0.1%. Again, nothing I would write home about too quickly. I would argue all the action is in the cross-asset story. We talked about the equity picture. The bond market, to me, is what matters here, because you are starting to see a little bit of a spike in yields across the curve when you look at that 2-year yield and the 10-year yield as well. The 2-year yield higher by, get this, 6 basis points higher to a 463 level. You look at the 10-year as well, 422 I'm seeing this morning, higher by about 3 basis points. Again, that's going to have a big story or a big effect on the currency picture. Dollar yen there, 151.43. That yield picture creating a little bit of dollar strength across many of the G10 currencies. Again, yen intervention watch, if I can make that pun, 152, 153, 155. You have different strategists all saying those are key levels to be watching on the technical front. And of course, Brent crude, given the geopolitical tensions around the world, plus that increase in shipping costs, all higher as well, higher by about 0.5%, trading at an 86 handle. But it all comes down to that inflationary story, and that's where we go next. Federal Reserve Governor Christopher Waller saying the central bank should delay or reduce the number of rate cuts seen this year. Policymakers have penciled in 3 rate cut reductions, but Waller says a strong U.S. economy and robust hiring may have given the Fed a little bit of room to wait. Take a listen.
In my view, it is appropriate to reduce the overall number of rate cuts or push them further into the future in response to the recent data. I see no rush in taking the step of beginning to ease monetary policy.
So what do you do with comments like that? Let's bring in a true expert. Peter Schaffrik, global macro strategist over at RBC Capital Markets, joins me this morning.
Morning,
the timing, good morning. The timing is so strange here. Traditionally, when you have a holiday like this, you see some of the data prints move. We're not seeing that this time around. What do you make of it? Is this a reason, are those comments reason enough to change your portfolio today?
Well, I wouldn't necessarily say so, and just because, I mean, you mentioned the bond market is key, and what we've seen is that over the last, I want to say 2 to 3 weeks, we've really sort of settled in a sideways range, maybe in the US about 390 to 430 for the 10-year, and over here in Europe, maybe sort of with a top at 250 and maybe 225 in the 10-year bond. And I think, you know, we're really seeing the split also in the officials' opinions and in markets' opinions, with some people saying, well, there is more inflation in the system and therefore we need to slow things down. And other people are saying, well, no, we're heading back to the target and therefore we can cut. And I think as long as that tension remains, I think the range will remain.
When we talk about that range, though, I mean, there's a big question of whether we get to, I mean, everyone's talking about that's right here, 3.5 to 4.5, whether we get to even 5 before we get to 3.5. Is that a possibility?
Well, I think it is a possibility, of course. In fact, you know, we have currently, from a tactical point of view, small shorts outstanding in our recommendations, because we think there is a risk that if we see some further inflation surprises to the upside, that the market probably breaks to the upside. But then we have very clear communication from all central banks or all major central banks that they will be cutting interest rates. So for me, that's not a question. They will be cutting. It's just then the question, that's probably what Waller was saying as well overnight, is then what comes thereafter? What's the speed? Where are they going to? And I think that's where the market will really settle on.
You say you have a tactical short on bonds at the moment. Talk to us a little bit about why that is. When you're seeing, fair point that the last 2 inflation prints have been slightly hotter, but the general direction of travel is downward. Why the tactical short?
Well, I mean, first of all, as the name suggests, it's a tactical one. So, but nevertheless, I mean, what we're seeing is, if you look at particularly for this year, but to some degree also for next year, we have the cuts already priced. In fact, we're probably pricing a little bit more than the 3 cuts that, for instance, the Fed is guiding for. We're pricing a little bit more than 3 cuts for the ECB as well. We think they will deliver only 3 this year. So that's already priced. We also know that from a positioning point of view, there's probably quite a few longs outstanding already, exactly for the reason cuts are coming. Therefore, ultimately, you've got to be long in the bond market. And then when you look at sort of the way the market has been trading, we've been kept in that range. But we reckon that if we have 1 or 2 more surprises to the upside of inflation, to the consensus, can still mean that inflation is actually coming down, but probably not as fast as the market is hoping for, then we get a bit of a breakout to the upside.
So the cuts, whenever they do finally manifest, are they a function of growth or slowing growth, or is that a function of normalization of rates? Where do you stand?
Well, it's certainly a combination of all of them, right? Because, I mean, growth is probably going to slow in the US, but it's probably going to pick up a little bit over here. What we do see is inflation is coming back down, but the question is whether it's coming down fast enough to the target. So the central banks, they probably feel comfortable enough that they can lower rates a little bit, and whether they can reduce interest rates much more, that will be in the future. That we will only know in the future. So the first 1, 2, maybe 3 cuts, that's going to be almost a done deal, I think. But what comes thereafter will very much depend on growth and inflation data.
Well, what happens with the dollar in that case? There seems to be a real divergence and dispersion between what the bond market is doing, what the FX market is doing. When is the dollar going to move? Well,
I mean, first of all, most of the FX pairs have been relatively steady. Let's leave the yen aside for a second. But if you look at the European pairs against the dollars, the European pairs against each other, they have been very, very steady. And I think one of the reasons for that is actually that we have a relative weakness over here in Europe. Because when you look at most fair value estimates would probably place, let's say, euro dollar closer to 115, 120. But it isn't. So I think we do see some sort of hidden dollar strength already. And the question in my mind is that if interest rates are coming down, whether that changes. And there's very little indication at the moment. So I think what we're seeing is that sideways movement that we're seeing is actually hiding the dollar strength to some degree.
It's interesting because the positioning is really crucial here. So many of people have been kind of short the dollar in a lot of ways, thinking that those rate cuts are going to materialize faster than expected. Just this morning, you're actually seeing, I think, more volatility than I've seen in weeks/months in the European currencies, around a 107 handle on euro dollar. When it comes to that inflation data, though, there's a talk about a 3% inflation story in the long term in the United States, when the target for the Fed is 2%. There's a lot of fun technicals around that. What does that mean? What does long-term 3% mean? Is that even plausible?
Well, everything is possible, of course. And one of the key things, and we're seeing that not only in the US, but we're seeing that over here as well, is that sort of the domestically generated part of inflation, that has remained much firmer or much stickier, I should say. It's not coming down as much as the central banks would like. And I think that's the crucial thing. If that remains the case, and obviously that's intrinsically linked with the strength of the labor market, the wage setting, and so on, with everything that also Waller was talking about overnight. If that remains relatively firm, and therefore we have an inflation sort of baseline that is stronger than what the central banks hope for, that means that they probably can't lower interest rates as much, and there's this debate about where the neutral rate of interest is. It's probably higher than in the past. The inflation component is probably be higher in the past, so the nominal rate can't come down as much, and that's obviously not priced in the market.
You're talking about those sticky parts of the inflation data, though. We're seeing that in housing. We're seeing that in wage data, obviously. How much of that is more of a fiscal story than a monetary one? And the reason I ask that is simply because we're talking a lot about wage negotiations around the world. How much of this is fiscal?
Well, there's probably some element of fiscal, because what we do know in the current environment, budget deficits are relatively wide, and some of the things that the public money is being invested in is probably very inelastic. So what it means is that if the economy is decelerating, it probably still is going to be there because there's a political imperative to fund, let's say, the green transition or energy transition and so on and so on. However, having said that, I think the key is still sort of the labor market. As long as the labor market remains tight, and we can have a big debate about why it's tight, but as long as it's tight, there's an intrinsic upward pressure on wages. And as long as that's the case, I reckon there's going to be strong demand domestically, and that means that there's going to be intrinsically high domestically generated inflationary pressures.
Lots to digest there, and you talk about that in this context of the United States. We haven't even got to the yen piece of that as well. Lucky for us, Peter Schaffrik is staying with us. We're not letting him go just yet, the global macro strategist of RBC Capital Markets. Coming up on the program, we're going to dive into that one piece of the equation we haven't hit yet, the story over in Japan. The wage story in the United States, the wage story in Japan, it's a theme we're seeing around the world. We're getting the latest on what's next for the yen. Stick with us. This is Bloomberg.
Our medium-term forecast is actually for the yen to strengthen somewhat. I think over the next year or so, we think it should head back towards 140, primarily driven by the thoughts of the Fed easing further down the road and somewhat tighter Japan policy. So we think that the medium-term picture would be for a slightly stronger yen.
Christopher Wilcox there, Nomura's head of trading and investing, speaking exclusively to Bloomberg Television earlier. I want to get a little bit more on the yen and what that intervention story might actually look like. Bloomberg's executive editor for Asia markets, Paul Dobson, joining me this morning. Paul, long time no see. Pleasure to have you on the program. Talk to us about this tension here. Do things get a little more tense over the weekend?
Good morning, Chrissy. Yeah, we're headed into quite a turbulent period for Japanese markets towards the end of the trading day today, and things have been very calm and kind of locked in quite a tight range. But it could go any which way in the next sort of 3 or 4 days. I'll talk you through some of the stresses that we have there. First of all, the risk that there's a little bit more depreciation, and that's enough to rile the policymakers in the Ministry of Finance enough to intervene and to try to push the yen in the other direction stronger again. 2, we've got a lot of options trades going on either side of where we are right now. Some of them are in the money, but if we were to get all the way to 152 on the weak side for the yen, that might be enough to knock out a lot of barriers, and that would spark further volatility as well. Now, in addition to all of that and the hedging that's involved around that, we're right at the end of the financial year for Japanese companies, and we're heading into this Easter holiday period as well. So markets are going to be thin on Friday. There may be some of those last month-end, quarter-end, financial year-end flows. And then we get the US PCE data right at the end of it all when basically everybody's already gone. Will there be a little bit more price action and volatility around that? If not, we come in again on Monday morning in Asia. Australia and New Zealand are on holiday, and, liquidity doesn't tend to be very high at that time of day as well. Japanese markets will be the first responders then. Could see more price movements up and down, more fun and games if you enjoy that kind of thing, or more treacherous conditions if you've got a lot of risk going on out there.
Well, aren't you just a ray of sunshine this morning, Paul, talking to us about the volatility in the yen space? Talk to us a little about the other levels, though. You mentioned 152. I've heard in the markets, technicals are playing more of a factor here if we don't see that intervention. 153, 155 has been put on my radar. Talk to us about the levels at play here.
That's right. Well, and I think that 152 is really the key because of where those barriers are. But then, what's the red rag for the MOF and for the Japanese officials? What would turn their hand? It's more about the pace of the move for them rather than the outright levels, or at least explicitly that's what they're talking about. They talk about the idea of a 10 yen move or a 4% move, in the space of a short period of time being an unacceptably quick movement. So if we were to see more volatility, particularly if we would get to some of those levels you mentioned in a short space of time, that would be enough to get them motivated. And I think, we're still seeing more of these signs that are giving the dollar that oomph, that strength on the flip side at the moment. We had the comments from the Fed's Waller. That's given the dollar some extra support. That's pushing back the timing of those Fed cuts. And as you were listening to the comments just a while ago, the expectation on the Japan side is that at some point, the Fed starts to cut, and that starts to take some of the pressure off at the yen. But the longer that they have to wait, the more likely it is we get into that sort of a scenario where the finance officials need to take some action, at least to slow the pace of appreciation and buy that little bit more time.
A lot to digest there. Bloomberg executive editor for Asia markets, Paul Dobson, walking us through the potential scenarios around that yen intervention watch. Still with us for a little bit more analysis here, Peter Schaffrik, global macro strategist over at RBC Capital Markets. Peter, before the break, we were just talking about this. What does the dollar do next? How much has Christopher Waller kind of given that support, as Paul was just saying? Let's fold in the Japanese yen now, which has really been the base trade for a lot of carry trades. My going theory, push back on this, if you will, my going theory is the very, very low FX vol that we've been seeing is largely kind of the complacency attached with this no-brainer carry trade around the Japanese yen. Look at what happened in just the last quarter here. Your best performing G10 trade was going long the dollar against the Japanese yen. How long does that persist? If we start to see this yen intervention, does that carry trade persist?
I'll come back to the yen. I just want to paint a broader picture. I mean, you were just mentioning the carry trade. I think this is a general phenomenon. We see that particularly also in the emerging market space, where we have a lot of carry trades going on in higher yielding currencies, which typically also have been performing a little bit better than the yen. Now, on the yen specifically, I mean, one of the problems that I have with this idea that sooner or later the yen will have to strengthen, that might well be the case, but A, from what level, and secondly, what is the time frame here? Because we have been talking about the same theme for at least the last 6 months, if not longer, and it hasn't worked. And one of the reasons I think why it hasn't worked is, A, because the positioning is already skewed that way, and I thought it was quite informative when we looked at the BOJ move last week. Going into it, the yen actually did strengthen just a little bit, and then when the actual move came, we just went back to 150 and beyond. Yeah. So that suggests to me that the pre-positioning lacks follow-through here, and there's probably still way too much positioning going one way that probably needs to be clearer. And then one further point on this, I mean, one of the biggest problems that I see with this is that at the moment, with the way the relative carry works against the yen, particularly for the domestics, is they have very little incentive in actually buying foreign assets and then hedging out the currency, which would mean sort of selling the foreign currency and buying the yen. So they have very little incentive to do that because if they do that, the actual sort of hedged return that they're getting is very low or even negative relative to their own investments. So in my mind, it's not as clear cut as we hear from a lot of places that the yen actually needs to strengthen and needs to strengthen quickly, interventions notwithstanding.
Well, it's interesting because it's coming off the heels of kind of the spooking effect, the start-stop effect that we've seen on a lot of these hedges that have been expecting, say, the JGB shorts to pay off. And it's taken ages for that to do so. Peter Schaffrik, global macro strategist over at RBC Capital Markets, we thank you so much for walking us through that story. Coming up, we make a hard pivot. I have really no smooth way to do this. Germany set to partially legalize cannabis for personal use in the coming days. We're going to discuss the opportunities for the commercial market next. This is Bloomberg. Treasuries drop as the Fed's Christopher Waller says there's no rush to lower rates. We're going to look ahead to tomorrow's U.S. inflation data. Meanwhile, in the stock market, the S&P 500 futures pointing to a higher open on Wall Street after closing at a record. Meanwhile, here in Europe, stock 600 hitting an all-time high on the last major trading day of the quarter. Plus, we are on intervention watch. The yen steadies with many traders now eyeing 152 per dollar as a possible trigger for officials to take action. Good morning and welcome to The Pulse. I'm Kriti Gupta in London, filling in for Francine Lacqua. There's a lot to digest in the currency space. We just talked about it there with dollar yen very much in focus. 152 is the level to watch. This is really, really interesting because it has been the basis of this trade. I'm showing you here a chart, or I should say a terminal function. You can WCRS on the Bloomberg terminal that just shows you a little bit of what that looks like, how some of the currencies have actually outperformed relative to the dollar. You've seen them actually, the dollar strength story, quite significant there. And I think, or dollar strength story is kind of quite significant there, I should say, in terms of relative to, say, the British pound, the euro. You're starting to see that upkeep in terms of the global stock picture. To me, what's most interesting is the worst performing currencies have, of course, been the Japanese yen and the Swiss franc, which, again, bring it right back down to that global basis trade that we've seen, the carry trade that we've seen around the world. Remember, just because the Japanese yen, or I should say the BOJ, has moved out of negative rates does not not necessarily mean that it is seeing the same sort of influx of flows that I think a lot of people may have once expected. That's the currency picture. There's a stock element to it as well, because as we talk about what happens with the dollar and whether it moves, there is a barrier of entry for international investors who want to advance into the S&P 500, into the Treasury market. I think this chart really shows why the outperformance in the United States, the consumer resilience that you are seeing is incredibly significant. You are also seeing it show up in Europe as well, where a lot of these corporate earnings stories are largely based on the U.S. consumer story, the consumer resilience story. It's really, really important to keep an eye on, and that's just the macro space. One example of that consumer resilience, one example of the United States feeding European companies, for example, shows up in Novo Nordisk. A new report saying the blockbuster obesity drug Ozempic could be produced profitably. Forget this, less than $5 a month. Denmark's Novo Nordisk charging almost $1,000 for the treatment in the United States. I'm joined now this morning by Sam Fazeli from Bloomberg Intelligence. Sam, this is a really interesting report that has already got politicians fired up on both sides of the aisle. Talk to us about kind of gross to net about the issue.
Yeah, hi. This drug pricing is emotive. It impacts a lot of people, and politicians love it. So when a paper like this is published, which was published in JAMA Network Open, it's not at all a surprise to me that they jump on it. However, there are many nuances here that have been completely missed, i.e., as an example, the list price that people quote often for an insulin drug, say it's $1, whatever, $50, say, right? Only 10% of that is kept by the manufacturer. These gross to net issues are significant and are often missed in conversations about drug pricing. Ozempic, example, is a 70% discount. So every 30 cents out of $1 is kept. Now, I'm not defending the pricing of drugs in the US. I'm not saying they're right, wrong, but there's a reality as to this drug would not exist if Novo Nordisk had not done the R&D on it and the 10 years of development that's gone on it. That costs money. We wouldn't have known that it helps people with their cardiovascular disease if they hadn't done a 17,500 patient trial over 4 or 5 years, which costs huge amounts of money. So we have to be very careful, and I know that a lot of people know this, to not just take these numbers on face value.
So talk to us about the utility of the study, though. Is there anything that we can kind of use out of it?
The utility, sorry, I didn't hear that. You just went out for a minute. The utility of this particular study?
Yes.
Okay. Well, look, it's not difficult to go and find data that shows that drugs, when you manufacture them, are cheaper. Cornflakes can be made for 25 cents, say, and the box costs $2.50, or you convert that to pounds, for 25 pence and £2.75 on the shelf. There is always a markup as you go through the supply chain, the box and the marketing, etc. So that's not news here. Obviously, these prices that we're talking about are significantly different. But the study is useful in its own right as to telling you how much it costs to get the active ingredient made. Then there's another layer here. Where are these drugs made? On the one hand, politicians in the U.S. want to distance themselves from China and regions which such regions where products are made, and at the same time they use this kind of study, which I'm pretty sure included manufacturing costs of drugs in developing countries or such countries such as China, as a base for their information, and they want to use that for fighting the pharma companies. So we got to decide: do we want to go and buy cheap products from China? If we do, then you could try and bring drug prices down in the U.S. using those kind of drugs. You can't have your cake and eat it.
Well, it's an interesting kind of dynamic that you mentioned there, the international story. You talked about those R&D costs, which kind of justify the pricing for Novo Nordisk, that very big upfront spend that you see, which is very common, by the way, from pharmaceutical companies and biotech, as you well know. But when could we see that pricing dissipate? Is this a years-long, a decades-long prospect?
Yeah. That's an excellent question, Kriti. And just to be clear here, I'm not justifying a particular price that Novo Nordisk has set or Eli Lilly has set or any pharma company has set. All I'm saying is that there are many layers of nuances in here that we have to be careful with. So in terms of drug pricing coming down, already Ozempic is gross to net of 70% discount. And that price is going to continue to fall. How do you end up with insulin at 90%? Through the same market forces. As new drugs come to market, as the volume goes up, there are systems in place that can reduce that price that people have to pay. Unfortunately, the drug pricing is so opaque in the US that nobody knows where the segments are and who's taking what margin where and who's getting an extra commission on a sale of a product or an extra margin on sale of a product in the line of folks involved between the manufacturer and the patient. So that's the problem that we have. We need transparency there, not just shouting at pharmaceutical companies.
I mean, that's something that I think both parties, both sides of the aisle are actively addressing. Bernie Sanders, for example, tweeting off of that report about that very issue. Sam Fazeli from Bloomberg Intelligence, we thank you so much for diving into the details around that report and what that actually means for Novo Nordisk. In the meantime, let's get to some of the other stories making news. UBS has cut its bonus pool by 14% after a tougher year for deal makers and traders alike. The Swiss bank has also increased its cost-saving targets amid the integration of Credit Suisse. Now, UBS's annual report revealed that CEO Sergio Ermotti was paid 14.4 million francs for just 9 months on the job. Ermotti being brought back in April last year to oversee the rescue and integration of the bank's former rival. Index provider FTSE Russell saying Portugal will be added to a key government bond index, but held off on a decision when it comes to South Korea and India for at least 6 more months. Portugal joining the FTSE World Government Bond Index from November. South Korea stays on the watch list for inclusion in the FTSE Global Bond Index, while India remains on watch to join the emerging market equivalent. And earnings over at Jefferies rose in its fiscal first quarter on strength in capital markets and renewed activity in the investment banking business. The New York-based firm says revenue jumped 35% on improved debt and equity underwriting as concerns around inflation and interest rates started to stabilize. And we go from banking to Amazon, where investing an additional $2.75 billion in Anthropic, completing a deal it made last year to back the AI startup. As part of the deal, Anthropic will use Amazon's cloud services as its custom computer chips. Anthropic was formed by former OpenAI employees and offers a chatbot named Claude. Now, coming up on the program, we go right back to the banking space. The world's biggest banks quietly hanging on to carbon-intensive clients, exposing the cracks in the world of climate finance. That story next. This is Bloomberg. This is the Pulse. I'm Kriti Gupta in London. We're getting breaking headlines here that the ECB is set to approve the first Greek bank payouts since 2008. The last time they did that, again, was right before the country's debt crisis started in 2010, right as well before the global financial crisis really kicked off. The significances of this is enormous, simply because the measure was taken back then because of the risks around not just the banking system in Europe, but the Greek debt story as well. The fact that you are now seeing this allowed again suggests that this is really a testament to the strength that you were seeing not only in the Greek bond market, investment grade, for example, now being given as that title to the Greek debt that was, say, just 10 years ago, seen as very, very risky. Now you are actually seeing that exposure to banks perhaps increase from global investors if they indeed pursue that dividend. The payouts, however, are likely to be less than the banks originally requested. They're really easing into this, but it is suggesting just that sign of normality that we have largely been expecting from a country in the periphery that has largely been outperforming some of its other European peers. So that is the story there. We'll get you more headlines as we get them right here on Bloomberg Television. In the meantime, the Lloyd's of London has recorded its most profitable year for underwriting since 2007. We spoke to John Neal, the chief executive of Lloyd's of London, and what's going right for the business.
We've been working really, really hard to get performance back in shape. So good to be reporting growth, good to show improvement in revenue. We wanted to get costs in order, and we've also wanted to show leadership. So a lot of conversations with us around diversity, equity and inclusion and around climate. And I do feel it's really important for UK PLC, because 80% of our revenue comes from outside of the UK. So to represent the credentials of financial services and what insurance can do in the UK is fantastically important. So really, really pleased to be reporting the results that we are today.
Yes, because a lot of people ask questions about the role of the City of London, I suppose, at this point, post-Brexit, and with the listing story not playing in London's favour. You know, a lot of businesses choosing to either leave or to list in the United States and elsewhere. But you feel from the insurance space, London still has a lot to offer.
I think it is the only true marketplace for insurance in the world, and we've reported double-digit growth now for 3 consecutive years. And to give you an idea of where the geography comes from, over 40% of our income actually comes from the United States. In fact, two pounds out of 3 of what we do comes from North America and Latin America. So real geographic spread in what we do, hugely valuable, I think, for UK PLC.
John, does the kind of performance that we've seen then over the last year, does that continue for Lloyds? And what do you, in terms of reinsurance pricing, they're relatively elevated. How does that story evolve for you?
So it's interesting. So last year was helped by 2 things, really. So the frequency and severity of natural disasters, and we'll talk about Baltimore in a minute, was slightly lower than we'd normally expect. So that was good news. And isn't it exciting to actually be making some money on our assets? So we quite enjoy having interest rates. So for the first time in like 15, 20 years, we're making money on both sides of the P&L. Yeah. So we do think the performance is sustainable. So there's always going to be a bit of cyclicality, but we don't think this is a one-off. You know, it's been a consistent, steady improvement in performance that we think we can maintain.
Not a one-off. And of course, the interest rate regime is likely to change this year. So that's going to evolve as well. Let's get to the marine insurance there and the Baltimore disaster. We know the bridge was insured, is insured, the boat's insured as well. There's a lot at play here. How material is this for Lloyds? Have you been able to put a number on it yet?
So from our point of view, as you would imagine, we go through multiple scenarios of different type of loss. Do we ever get every loss right and consider every loss? No. But the type of loss that we've seen is one that we would envisage. So we would assume every year this type of loss will occur for us somewhere. So within our financial considerations, manageable. And you said in your remarks, which is something that's so important, you know, when I think of natural disasters, what upsets us most as insurers is we have the capacity to insure, and almost every loss you see is only half insured. People aren't buying insurance, so we don't do a good enough job of selling the value of insurance. In this instance, as you've just said, the boat's insured, the bridge is insured, the Port Authority's insured. So from a financial perspective, the money is there to deal with the loss. I mean, there'll be the issues of what happened and whose fault was it, and all those debates will rage, but the good news is this is insured. And
so to help us understand, with your marine insurance expertise, you know, what are the types of claims then that we're talking about? What are the building blocks that we need to look at to add up to the full picture of insurance exposure around this event?
So you've got the easy bit, which you can see that, you know, I mean, these things today play out on our TV screen.
Yeah.
So you can see the damage to the boat, you can see the damage to the bridge. You know, the cost of the bridge will run clearly into hundreds of millions of dollars, as will the damage to the boat. These boats are 400 metres long and 300 metres high. They are vast in terms of size. So you can see the easy bits. The complicated bits are the supply chain related issues. What impact is this having on the ability for goods to move around the world? What delay and what interruption does it cause? That's the harder bit that takes a little bit of time just to work its way through.
Yeah, just back to the sort of the Lloyds marketplace and its role in this. I mean, analysts at Barclays say that some of the smaller Lloyds firms may be the most exposed to the Baltimore Bridge claims. Have you estimated that? Have you got anything you can tell us on that front?
So I don't think that's correct. I mean, interestingly, with the insurance of shipping, there are these clubs called Protection Indemnity Clubs. There are 12 of them. They gather together under the international group. They insure 90% of the world's shipping. And then they buy insurance, if you like, they lay off with us and others, so we reinsure them. So there's quite a complex weave of insurers that are involved with this, but it's the international group that sits at the bottom of the chain, and they will deal with the loss. But no, I agree with Barclays that this has the potential to be one of the largest marine losses in history, but no, I don't think we've got anything that's causing us concerns to think that anyone...
Just on the Barclays point, $3 billion is the number they put on it. Does that sound about right to you?
It could be. I mean, it's a multi-billion-dollar loss. I think it has to be, but I think it's a little too early to say what do you actually think it's going to cost. But, you know, in terms of the earlier question, do we sort of scenario manage and anticipate losses of this size? The answer is yes, we do.
John Neal, the Chief Executive of Lloyds of London, speaking to us earlier this morning, talking to us about what the insurance costs around the Baltimore Bridge and the wider tensions in the shipping space actually means for the company and for some of the other banks involved as well, which brings us to our Bloomberg's Big Take. The world's biggest banks quietly hanging on to carbon-intensive clients because of what they see as unrealistic demands from regulators and civil society. and the threat to their fees. Joining me now for more on this, Bloomberg's Alistair Marsh, all over this story. Now, on the surface, it's not that exciting. If you go into the nitty-gritty, it actually really is in terms of this connection between the banks and this climate transition. They're feeling pressure really on both sides. Talk to us about how far they've actually gotten, what that relationship looks like.
Sure. Well, I'd say it is very exciting.
Oh, I believe it. You made me excited about it. Go ahead.
Well, here's why it's exciting. It's exciting because the energy transition, i.e. the movement of the fossil fuel-based economy that we have today to one that's based on low-carbon energy sources, will be a massive economic transformation that requires trillions and trillions of dollars of investment and financing, which is where the banks come in. Now, all of the major Western banks, North American, European banks, have made net zero commitments. They did that about 3 years ago. They've said essentially that our lending and financing will be aligned with the 1.5-degree target that we sort of globally have set in Paris, at the Paris Climate Accord. But actually, that's easy to say, hard to deliver on, because the reality is the world is way off track from 1.5 degrees, and many of the most profitable clients today are fossil fuel companies. There's been a real resurgence in the last few years of, big oil profits, and those are the kind of clients that you want to keep on your books. But you can't really keep them on your books if you want to if you want to stay true to what you've committed around climate. So there's a real tension here, and this story is about that, basically.
Is that an unrealistic expectation from the get-go, though?
Well, I think a lot of banks were happy to kind of over-project what they could do at the beginning. There was this sort of idea that banks would be the climate saviors, that the private sector would lead here. And actually, it turns out the private sector appetite for leading is diminishing by the day, because of some of the things I was mentioning just now about the resurgence of fossil fuels. So yes, it was perhaps naive and ill-advised to expect that the finance sector would lead this, but as I said at the beginning, the transition comes with a price tag of $5 to $10 trillion every year. Where's that money going to come from? Mostly from the private sector, from banks. So without the banks and without the investment managers, there will be no energy transition. So, yeah, it's complicated.
Well, add one more kind of perspective into the story. You cited a UBS banker. What did he say?
Sure. So in the story, we cite this banker, Judson Berkey, who's essentially UBS's head of sustainable finance regulation. And he kind of let loose on regulators at a meeting in Tokyo. And he said, it's unrealistic that you request that we banks align our lending, our financing, our investing with a 1.5-degree world, because we don't live in a 1.5-degree world. We live in a world that's on course for 2.8 or maybe 3 degrees of warming, which, by the way, is catastrophic. And so how can you possibly expect us to align with that? The only way that you align with 1.5 is you divest today of most of your carbon-intensive clients. And that's clearly something that banks don't want to do, because those clients are very profitable and they have long-term relationships with them, and that doesn't get us anywhere towards net zero. So there's this real tension at the heart of banking today.
Yeah, certainly something we're going to be keeping a very close eye on. Bloomberg's Alistair Marsh walking us through that crucial story, the tension in the banking space and the climate finance space as well. Coming up, we take a different approach to Wall Street, this time in the IPO market. Reddit suffering its biggest drop in a day as one researcher casts doubts on the share price. Those details next. This is Bloomberg. Reddit shares notched their largest one-day drop since the social media company's trading debut last week. As well as Hedgeye Risk Management released a report adding it as a short idea and saying it should fall, get this, 50%. Bloomberg's Charlie Wells holding on to the edge of his seat here. What's the rationale behind the short report?
I mean, look, they're kind of asking some of the key questions that people have been saying about the markets lately. And it's, how far can this bull market go? And then also, Reddit pitched itself as an AI company, or at least a sort of AI adjacent company. And I think the big question here is, how bright is that AI halo? How long is that light going to last? Hedgeye is basically saying that they see a positive earnings report coming in May, but they're concerned about what happens in the second half of this year and the first half of next year. They think this stock should be valued at about $35 a share, close to that IPO price.
That is a scary level. And of course, we'll see that because it's kind of been this beacon for risk taking that we've seen in the broader IPO market. And speaking of risk taking, we got to talk about crypto here. It's a big day for FTX, for Sam Bankman-Fried, a U.S. district judge scheduled to have that sentencing. Prosecutors arguing that the former CEO of FTX, should get the 50 years in prison. 50 seems to be the magic number. How is today likely to play out?
Well, look, I mean, this is going to be sort of a bellwether moment for crypto crime. I mean, it's really interesting. We're in that bull market for crypto right now. It's almost easy to forget that crypto winter and all of these, allegations and as well as convictions that came out of the previous bull market. And look, there's a wide gap between what prosecutors want and what SBF's lawyers want. So there's that 40 to 50 on the prosecution side. His lawyers have been asking for 6.5 years. And so this could be a bellwether depending on where the judge falls.
Bloomberg's Charlie Wells, lots on his docket. We thank you so much for bringing that. And later today, as he said, we'll be watching that very closely. We'll be live at the Federal District Courthouse for that case. Live coverage starts at 4 p.m. London time. Stick with us. This is Bloomberg.